welcome to our first Cup of Joe for 2024. I'm Joe Gallimore, Director of Investments with Argent Bridge Advisors, and let's get into it. 2023 is done and dusted, and what an interesting year it was indeed. Wall Street started the year with an overwhelming consensus that recession was imminent, but that has yet to materialize. After raising interest rates 7 times in 2022, the Fed hiked rate 4 times this past year, but has paused since August. And that pause, that has seemed to pave the way for not only lots of market optimism, but also for some real recovery across the stock market as a whole, and not just in pockets of certain stocks. Speaking of pockets of stocks, we talked a lot about market index concentration in 2023, and I even shared some stats about that in my Cup of Joe from last month. Well, the S&P 500 did not disappoint and ended the year with the top 10 names accounting for 32% of the index, a whole third. And those 10 names were responsible for an eye-watering 86% of the return from last year, according to JP Morgan. Now, that does not sound like diversified investing to me. So what I want to do right now is I want to do a quick review of the path that the market took in 2023 and highlight one of the concepts we're going to take with us into 2024. Now, this chart you see here is of the S&P 500, and even though we talked about how concentrated that index is, this chart is representative of the shape that most US equity indexes took last year. So what we see is that things started hot out of the gate. The Fed ended 2022 with its first decline in rate hikes. So investors at that point started looking farther down the road, and things got out to a real strong start in January. But then in February, does anyone remember Silicon Valley Bank? Yes, there was a regional banking crisis as banks started really feeling the weight of higher interest rates. That lasted about 5 to 6 weeks here. And then as we got into spring and summer, the market accelerated strong and went all the way up through July 31st. Now, I'm going to call this a frothy market. This is when I started talking about on my Cup of Joes how the market may be getting out over its skis. And that's when valuations of stocks really started to get ahead of the fundamentals of those underlying names. Then, beginning in August, the market started a 3-month decline. The Fed actually paused their rate hikes on interest rates here and started talking about keeping rates higher for longer. So there was some profit taking, Fed talking about keeping rates high. That led to a 3-month lull in the market. Then, right around Halloween, we'd seen 3 months of persistently positive economic data. And I guess investors had, just decided they'd waited long enough, and the equity market accelerated sharply. And so did the bond market, I should mention. So the markets took off, but the big distinguisher here is that there was a lot of market breadth. It was not just a handful of stocks performing during this time. In fact, in November and December, the S&P 500 equal weight index, that outperformed the cap weighted index over those 2 months. And small caps outperformed mid caps, which outperformed large caps. So when the market shows real breadth like this, we see this as a very good sign of what may happen when a sustained recovery finally takes hold. And who knows, that may have already started happening. So one thing I want to highlight during the course of this year is small pockets of volatility. There were 5 main legs to this path this year. 1, 2, 3, 4, 5. But within each of these segments, there are sharp reversals in the general trend. See that here, here, and even in this 3-month decline, there was kind of a big roller coaster ride on the way down. And even in the 2-month sprint to end the year, even the hair has to stop and take a breather a couple times on the way up. And what these are, these relatively short pockets of volatility, these short periods of time, they can feel unnerving. They can feel confusing about what's actually going on. And they certainly tend to invite doubt as to whether changes to your plan need to be made. I want to carry that theme with us into 2024, because the natural question now is, what's ahead? Well, the only real answer is no one knows. Recession is still possible, but it's less likely than before. And opinion on what the market's going to do for this year, those opinions vary widely. Let's remember that at the start of 2023, not one single talking head we heard predicted a 26% return from the market in a year which would include a 10% drawdown and the second, third, and fourth largest bank failures in US history. Looking at other things, if inflation continues to stabilize, then it's expected that the Fed will start cutting interest rates in small increments. This would certainly be a big positive for the markets and for the economy at large. But those rate cuts, they're not promised. There's certainly no guarantee on those, and there are several factors that could cause the Fed to pause for a longer period of time. Now, one key thing among all this guesswork is to stay invested. Even if the Fed is in a wait and see mode, the market will likely operate in these fits and starts as the economy tries to get going, these short-term pockets of volatility we just went over. And geopolitical tension, it's real high right now. There's two wars going on. US and China are trying to figure things out. There's a myriad other issues. Even if these tensions were to take sharp turns, unfortunately, that may cause hiccups in the market. But one thing that's a fact is that markets persevere through geopolitical events as well. Now, the Fed may be done raising rates, which would be a good thing. There might be more unexpected fallout from higher rates, and external events that are totally out of the blue, they might pop up as well, as they always seem to do. So this is just a friendly reminder to stay the course no matter what. Because if you miss only a few days of good returns during market rallies, this can significantly affect your long-term outcome. So staying invested is always the way to go. Now, to close, since we're in a new year, I want to touch on a few planning principles for 2024. First is go back and have another look at your company retirement plan, and then share the details with your advisor. I mention this because how much you contribute and when you contribute, that can actually make a big difference. And you may not be optimizing it as well as you think you are. So be sure to ask your advisor about that. Number two, don't jump to making any investment changes. A calendar year turnover it's a psychological trap when it comes to your portfolio. Investing exists on a continuum, which tends to move in cycles, and those cycles usually don't care what month it is. But just in case some of you feel a little compelled to take action, don't worry, we have your back. We did rebalance portfolios twice in the fourth quarter, and positioning with what we see as the road ahead. Quick reminder that IRA contributions for 2023 can still be made up until you file your taxes. So if you haven't done that yet, take a look. And if you're unsure about your eligibility for that, just ask us. Happy to help you out with that. Fourth, savings rates are great right now, but these savings rates are not expected to last forever. And with rate cuts potentially in the future, yields on money market funds, those are the first things to decline when the rate cycle turns over. So let's get together and strategize about putting some of that excess cash into a more sustainable plan for the long term. That does it for the first cup of Joe 2023. Thank you very much for watching. We have lots of content on our website and our YouTube channel. So if you're interested, please go check those out to learn more. Have a wonderful day, everybody. Thank you.